Welcome everyone to today's Explainer, Mastering Financial Risk, Chapter 1. I am absolutely thrilled to be your financial risk management tutor today. We're going to take a really fascinating journey together, and I promise you, we aren't just going to stare at dry numbers or abstract theories. We're actually going to trace the very DNA of financial risk, all the way from ancient Babylonian history right up to the high-stakes decisions happening in a modern Philippine corporate boardroom today. So if you've ever wondered how businesses actually survive sudden massive economic shocks, well, you are in exactly the right place. Let's get started.
Okay, let's dive right into this. Before we can even talk about modern banking, we have to look at the very foundation of finance itself. And it all starts with the etymology of trust. The word credit, it actually comes directly from the Latin word credere, which translates to believe or to trust. I really want you to hold on to that thought throughout this whole explainer. Every single modern credit transaction you make, whether it's just swiping your credit card for a coffee or a bank lending millions to a massive corporation, it is quite literally a quantified measurement of trust.
And measuring that trust? Well, it's an ancient practice, like really ancient. Way back in 1750 BCE, the Code of Hammurabi in ancient Babylon introduced what are essentially the earliest formal credit risk management rules. They capped interest rates, sure, but more importantly, they had built-in debt relief clauses. So if a catastrophic flood came along and destroyed a farmer's crops, their interest payments for that entire year were legally waived. Think about that. They were managing systemic default risk over 3,000 years ago. You can actually draw a direct, highly relatable parallel to this right now. Just think of modern Philippine calamity loans or crop insurance. The second Pegaso raises severe typhoon signals, those relief mechanisms are triggered. The technology has evolved, but the core risk management principle, it remains exactly the same.
Now let's look at the big picture with this core summary table. Consider this your ultimate study guide cheat sheet for financial risks. When we break it all down, we're basically dealing with four main categories that are driven by unpredictable movements in the market: market, credit, liquidity, and operational risk. For example, a local jeepney operator who suddenly has to deal with massive diesel price hikes, they are facing a very specific type of market risk called commodity risk. Meanwhile, a Metro Manila bank that's lending money out to small businesses is actively managing credit risk. Let's break these categories down one by one.
First up is market risk, which is sometimes called systematic risk. Simply put, this is the risk of financial loss caused by adverse movements in broader market prices. This covers interest rate risk, equity risk, foreign exchange or FX risk, and commodity risk. So the crucial point here is this: market risk affects the overall market and literally cannot be entirely eliminated just through diversification. Say a national economic recession causes consumer spending and overall stock indices to just plummet by 20%, well, an investor's portfolio value is going to decrease regardless of how perfectly managed those individual companies actually are.
Next up, we have what I like to call the terrible twins of corporate failure: credit and liquidity risk. Credit risk is simply the danger that a borrower or a counterparty is going to default on their financial obligations, meaning they fail to pay the principal or the interest when it's due. This includes default risk, concentration risk, which is like lending way too heavily to just one single industry, and sovereign risk. Liquidity risk, on the other hand, is the terrifying inability to meet your short-term financial obligations as they fall due. This happens when assets can't be quickly converted into cash without taking a massive, massive loss. Imagine a property developer who has, say, $50 million in land, but only $50,000 in actual cash. When a huge payroll hits, they literally can't pay their employees. They are incredibly wealthy on paper, but financially paralyzed in reality.
All right, our fourth pillar is operational risk. Now, unlike the others we just talked about, this one isn't about market prices or bad borrowers. This is the risk of loss resulting from inadequate or failed internal processes, human error, system failures, or external disruption. We're talking about massive non-financial breakdowns here. Just imagine a major bank's online payment system suffering a total software crash during peak hours, and it accidentally executes duplicate transactions for thousands of customers. The financial market didn't cause that, right? But the financial loss from the technical remediation, the regulatory fines, and all that administrative refund processing, it is going to be absolutely massive.
Okay, now that we've totally mastered the theory, let's transition into some high-stakes practice. Meet Island Brew Philippines. They are an incredibly popular homegrown milk tea and coffee chain with 12 branches scattered across Metro Manila and Cebu, run by a management team led by Jay Camote. Now, their signature absolute best-selling drink is this amazing salted caramel milk tea.
But here is the catch. To get that perfect signature taste, they have to rely on imported tea leaves from Taiwan and imported milk powder from New Zealand. And, this is the important part, those global suppliers price everything in US dollars.
But then, boom. Over the last quarter, a sudden dual market shock hits the business hard. First, foreign exchange risk rears its ugly head. The US dollar to Philippine peso exchange rate jumps sharply, going from 55 pesos all the way to 62 pesos per dollar. Overnight, without them changing their recipe at all, their imported raw ingredients are magically 13% more expensive. And it doesn't even stop there. Second, they get absolutely slammed by inflation and commodity risk. Local sugar prices in the Philippines spike due to sudden supply shortages, and their local logistics and delivery costs just skyrocket because of major diesel price hikes.
And this situation right here brilliantly illustrates the ultimate executive dilemma. Island Brew's total cost of goods sold, their COGS, has just surged by 25%. Their profit margin has basically been wiped down to zero. The clock is ticking loud. If management keeps their menu prices exactly the same, they're going to start running operating losses within 60 days. But on the flip side, if they aggressively raise their prices just to protect those margins, they risk completely losing their highly price-sensitive student and young professional customers. Those customers will just go to the low-cost competitors offering 50 peso milk teas right across the street. So what in the world do they do?
Let's move on and see how this builds, because this dilemma basically leaves the management team with two distinct strategic choices. While there are a few options floating around, we are going to focus on a high-stakes trade-off analysis between option B, which is local sourcing, and option C, which relies on financial hedging. Both of these aim to solve the problem, for sure, but they introduce entirely different sets of new risks.
Let's look at option B first, local sourcing. This strategy involves completely redesigning the menu to use locally sourced Philippine ingredients, like shifting over to local Benguet coffee or finding local dairy substitutes. Now, from a purely financial perspective, this is a brilliant move. It directly eliminates foreign exchange risk entirely because everything is now bought in pesos. However, the drawback is pretty severe. It fundamentally alters the signature taste that made Island Brew so famous in the first place. Plus, it introduces a massive operational risk. You are asking a 12-branch chain to execute a total supply chain pivot almost overnight. If the local suppliers can't handle that kind of volume, operations just grind to a halt. Now, what's really interesting about this next slide is how it tackles the issue from a totally different angle. Enter option C, financial hedging. Here, management decides, nope, we are keeping the original recipe to keep the customers happy. But to protect themselves, they lock into a 6-month forward contract with a local bank to freeze the USD exchange rate at exactly 60 pesos. This beautifully mitigates future FX risk by giving the company complete cost predictability for the next half year. The catch? It requires Island Brew to absorb the short-term premium costs using their emergency cash reserves. By tying up their vital cash buffer like that, they are actively creating liquidity risk for the company. They're saving the recipe, sure, but they're stretching their wallet dangerously thin. Okay, I want you to completely shift your mindset right now. You are no longer just a student watching this explainer. You are now the executive team of Island Brew. You've weighed the operational risks of alienating your customers against the liquidity risks of financial hedging. Now you have to step into that boardroom and synthesize these complex trade-offs into a decisive 3-minute elevator pitch to defend your chosen strategy to the board. A winning boardroom pitch needs a solid, energetic structure which breaks down into 3 simple steps based on our case study. Step 1. Clearly identify the specific risks. Don't just walk in and say, hey, things got expensive. No, you say, we are currently facing severe foreign exchange risk alongside localized commodity price risk, resulting in an unsustainable margin squeeze. Step 2. Own the downside. Do the trade-off analysis out loud. State clearly what the biggest danger of your chosen strategy is so the board knows you aren't blind to it. And step 3. Connect your strategy to the real world. Show how macro factors, like the strength of the Philippine peso against the US dollar, literally demand this specific defensive maneuver.
So if you decided option B was the best path for survival, your executive recommendation statement might sound a little something like this. To protect our margins without risking our liquidity, we must strategically pivot our supply chain locally. Yes, it introduces the operational risk of a menu redesign, but it definitively insulates us from unpredictable global currency markets. See what we did there? You name the risk, you accept the trade-off, and you decisively point the company forward. Because at the end of the day, financial risk management isn't just about massive Wall Street banks, right? It's about the survival of the businesses right there on your street. So I'm going to leave you with a question to really think about. How is the current peso-dollar exchange rate secretly impacting your favorite local coffee shop right now, today? Are they hedging? Are they localizing? Or are they just slowly absorbing the losses? Take these frameworks we've learned today, look out into the world, and start spotting the risks for yourself. Thanks so much for joining me on this explainer, and keep learning.